Hello and welcome to the No Pricks Allowed podcast with your host, Aaron Buchner from Cactus. I'm Wendy McConnell. Well, hello, Aaron. How are you today?
I am doing okay. I'm tired, but I'm okay. I went out late last night. But I gotta have a life a little bit, you know. We talk about that on the show.
Partying a little too hard?
Partying, socializing, it's part of life. And I tell people to enjoy life and go do things. It's like, I gotta go live my life and have a little bit of fun, right? Or am I not allowed? Is that
Yeah, but then you got to pay for it the next day, right?
Yeah, I will pay for it. I'm okay right now. The coffee is kicked in.
Oh,
I'm
good.
on number 4 this morning, so
Wow.
I'm well caffeinated.
Probably too
But
much.
yeah, probably a little bit too much. I'll crash probably around 3 o'clock. 3 o'clock, I'll be like, oh, I can't do this, and yet I've got meetings all afternoon. So we'll
Oh,
see how the rest of the
no.
day goes for me. It'll be fun.
Maybe we can get done early and you can take a nap.
Leave me. Right, there we go. Priority. Yes, I will take a nap.
All right. So today we're going to be talking about investments and what we should be investing in.
I wanted to continue on all the spiels we've talked about because we've talked about budgeting and understanding how to create a budget, and we've had talks about prioritizing your life and how to build like a financial plan and taking that step back and thinking about, okay, what do I want to do? Kind of the next logical step for a lot of people is, okay, how do I invest now? And everyone always has these questions online, and I'm sure you have it. It's like, well, how do I invest? What should I invest in? And I get it all the time. People, it's like one of the first questions, like, what should I do? I'm like, but the problem is there's no answer. Like, I know people want like the cut and dry, black and white, invest in this fund, but there isn't one because everyone's life is different. And we can't assume what works for you, Wendy, isn't going to work for the next exact same person because you're going to be entirely different than that other person.
Well, we're all different. So, yeah, we're all going to have different needs and desires, really.
Exactly. So trying to narrow it down of this is the fund is next to impossible because it's going to be based on who you are as a person. And even when I meet with new clients and they come in, that's the first thing we do is I'm not telling them, okay, where to invest, how to do this. It's I got to understand who you are as a person. We have to have that connection and an understanding of who you are. What are your behaviors? What are your priorities? How anxious do you get with the stock market? Do you worry about certain things versus not? Because all those are going to take into effect that if I was just say, oh yeah, invest in blank fund and everyone go into it, I can guarantee you it's going to be wrong for a lot of people out there.
Okay. So, when we're trying to decide what are the things we should be keeping in mind?
We can't break it down to just the numbers and say, okay, based on your time frame, this percentage and this much money to reach your end goal. Like everyone wants to break it down in those 3 pieces: the length you have, how much you can invest, and what's your potential return. But we have to add in all these other variables of your behaviors and what stresses you out and what keeps you up at night and how do you react to the market, because those are going to have a huge impact on how to choose between different investments. I look and go with my wife and myself, our portfolios for investing are different. We have the same time frame. She's just 1 year younger than me, but we have the same time frame because she's going to hopefully retire when I retire. So we have the same time frame. We have the same amount of money to put in, but our reaction to the market is very drastically different between the two. And my portfolio is slightly riskier than hers because I can handle it. I understand it. I know not to worry about how the market fluctuations affect me versus her. She's more conservative. She's a little bit more defensive. She doesn't want to take those high risks and go crazy. So she takes a step back and is a little bit lower, but that gives her peace of mind that when we look at the investments and we say, okay, how are we doing? She's not having a panic attack at night of, whoa, what just happened between the two. So a lot of it is, yeah, when we're looking at funds, you got to think about that part. I think the other part a lot you have to think about is the diversification and the spreading out. diversification is always a big thing. Don't put all your eggs in one basket, but it goes further than just thinking, okay, one stock. People think, okay, if I'm diversified, if I pick an index fund, I'm more diversified because there's 500 companies versus one company. And yes, you are more diversified. I'm not going to deny that fact, but you're still secluded to one demographic, such as just within the US or just within Canada. You need to go more globally diversified. So if you're looking at funds, I would always suggest go for a globally diversified fund that is spread out all over the world, not just to one country specifically.
So when you're talking about risk and how much people can handle, I mean, I've kind of been given the idea that when it comes to our long-term investments, we should really just leave it alone. We shouldn't be watching it. We shouldn't be like paying attention to it. We should be thinking long-term. And even if we see a short-term dip, that we need to ride that out. And, historically, it's come back.
Yes. And in theory, people should do that, not look at it, but everyone does. Like,
Okay.
you can't say you're not going to look at it, because people look at me. It's like, we review and we'll have conversations on a yearly basis. Like, guess what? We're looking at your investment returns. Like, you can't
Right.
just ignore it. And human behavior, I'm like, you're putting money into the market with the hopes of it growing. You're going to go look at it. Like, who would go buy a lottery ticket and never see if they actually won the lottery? It'd be weird. Like, go, oh, I'm going to go buy a lottery ticket, then rip it up. It's like, no, you're going to go look at the numbers when they draw the numbers. Oh, maybe I won. So it's the same thing with investing. You go put $500 or $1,000 or continuously putting money in the market. You're going to want to see that grow. You're not going to sit back and ignore and not know what's happening. And yes, historically, when the markets go down, they should come back up. Can't guarantee it, but historically, yes, they have. And the one thing you have to think about is, with the risk factors, it becomes how much time do you have? Because that return from a dip, how many years it's going to take to regain your loss, is going to depend on your risk levels and how close you are to retirement. It could take 2, 3, 4 years, depending on what you're doing. But I always tell people, if there is a dip in the market, the first thing is, don't panic. Don't pull out funds. Don't change your investment strategy, because that's going to be the one thing that's going to hurt you the most. Because if your investment for the portfolio goes down 10%, you in theory need 11 or 12% return to get to break even between the two. So if it goes down 10 and then you go, oh no, I need to move into GICs because I'm worried, and you're only getting a 3% return, that means it's going to take you almost 3% return on a yearly basis. You're talking 4 years before you're back to square one. You're still in the negative for 4 years. So you don't want to have those panics, and you have to think long term and try not to listen to the news and panic and worry about when bad things happen, or watch the investments all the time.
So you think that people should go more high risk? I know that you're going to say no.
Not necessarily.
Right. You take that attitude, though. You go a little bit more higher risk because you know how to keep yourself calm.
I know how to keep myself calm. Like, it's part behavior, but then it's also part of the risk levels of, I know my capacity to, my tolerance to take on risk, my ability to see a negative number and not worry, or see a positive and not go, oh my, I got to put more money in, and start thinking, oh, this is the best thing, and dump more money in. I know, okay, it's long term. I'm in the right fund. It's kind of, these are the funds. I'm rebalancing. I'm not touching it. And my composure's there. I've been through market downturns. I've seen it. I don't react. I just kind of leave it the way it is. The last one, which most people know of, the 2020 March dip, it's like, it happened. I'm an, oh, okay. I just went with my day. My risk capacity, but I also have calculated what I can do. So in terms of risk capacity, so when we're talking about what my lifestyle is and can I afford to take on higher risk financially, or am I okay with it? Do I need to pull into those investment funds for whatever needs should I lose my job or underperform in trying to gain this business and grow money? I know where that level is that I'm okay. Certain people, they might say, yes, I can take on more risk or believe they can, but their capacity to do it is not there because they're missing emergency funds or they don't have a budget to help give that that buffer to take on higher risk, or even their composure. They're watching the markets all the time. They'll get FOMO. They're going to worry of, oh, wait, the stock market's going to crash. There's tariffs coming in. Oh no, I should pull out of this. Should I do that? Like that. So all of those will take into effect. But I think the one other thing is when we talk about risk is I think everyone wants to go higher risk, because if they're putting money in, they want to get the best performance they can out of it. They don't want to be put it in and go, oh, I'm getting moderate return. They want to get those high numbers. It's like, oh, I want it to be the best it is, like where it needs to be. But a lot of times people don't need that level of risk. Sometimes when you do those calculations of when you do the mathematical and take out the behavior, you may not need a 10 or an 8. You may be comfortable with a 6% return, and that's all you need. So why take on more risk and cause more anxiety in your life when you don't need to? Go with the lower risk. Go what makes the most sense for you, for your happiness, as well as your reaching your goals. And that's where you should stick. I don't think everyone needs to go higher risk as much as they want to.
So when it comes to what we're putting where, how do we figure that out?
This is always the fun, and this is the one I have fun when I meet with clients, because we all have different goals. You have a bunch of goals. We've talked about boats with you, and no, it wasn't a cottage. No, you didn't want a cottage. It was definitely boats. I remember that.
It was a boat, yeah.
But there's all these different pots, and people will come and say, okay, well, I have retirement I want to take care of, but oh, I have my kids, and then oh yeah, I have this mortgage I have to deal with, and possibly I have this debt, and oh wait, I still have to do an emergency fund. So it's not just one thing; it's these multiple. So a lot of it is you have to prioritize. The same thing we've talked about many times on this is, what is your top priorities? What is the key thing you want to take care of first, so that you are happy and it gives you that fulfillment in your life, and like, I'm doing the right thing, even if it doesn't make sense. I guess it's the right way to say it. Like some people, it's like they'll look at and go, I want to ensure my kids don't go into debt and be able to go to school. So I want to make sure there's enough money in that pot for my kids. Like that's their goal and that's their priority. And they'll put it above retirement. It's not wrong. We can't say it's wrong because that's who they are, but we need to understand, okay, if we make that choice, if we look at it and say, okay, if your choice is to take your $1,000 you could invest and put it all towards education and saving for your kids, what is the long-term impact to your retirement? How does that affect you? Because you're putting all the money into this pot versus the other, and how do we find that balance? And I think a lot of it is educating people on, okay, we can do this. This is the impact. And the only way we can make up for it is either through pulling the only two things we actually have control, because I can't control the stock market. I won't say go higher risk because I don't know what that means in the end. It's either do we push out your retirement goal because we can't make it, or you need to find more money or cut back and put more money into that retirement. So when you're figuring out that pot, it's okay, what are the priorities? What are the top things you want to do? And then it's understanding what are the impacts. If you pull one lever versus the other, or focus on one versus the other, what are the long-term impacts? And understanding, okay, if I do this, I have to do this. And if I don't do this, this can't happen. And just understanding what are the sequence of events that will happen based on your decisions and your priorities.
So like if I felt that having a boat now at this time in my life was more important than saving for retirement, I would just have to talk to you about, my choices and figure out a way to fund the retirement fund either later or cut back on something else or, but you're not going to tell me I'm wrong for prioritizing a lifestyle with a boat in my backyard over retirement.
Absolutely not. Like, no, like
No, I feel like that I feel like most people would be like, that's stupid. What is wrong with you?
Oh, and I know. And a lot of people do that. And you can't tell someone their lifestyle is wrong because it's their life. Like, we can't say what you're doing, your choices are wrong, Wendy. No, you can't have a boat. You can't do all these skirts from Amazon and go pickleballing. No,
You sound like my husband now.
it's like, you can. I hate telling people they're wrong. There is no wrong to it. It's okay. If that's your goal and that's your priority, I want you to understand what are the impacts. If you want to have that boat and that's where you're focusing your life is, I want to have that boat and I want to have it in 5 years. Give me that boat, Aaron. And I'm going to explain to you, okay, this is how we get to that boat, whatever it is, based on the amount of money. This is how you save. But understanding you, it's like, okay, because we prioritize the boat, your retirement's now pushed out by 3 years because of that. Or I look and go, okay, but you may look at me like, oh, I don't want to do this for 3 more years. Like, give me the boat and retire on time. I'm like, okay, well then guess what? Wendy, you got to find out you need to find another $1,000 a month to do this. You just have to figure out, okay.
No problem.
Without gambling, without going to the lottery, and without telling me to, hey, give me a better return in the stock market, Aaron. I can't control the stock market. So it is that education. It's understanding, okay, what are the impacts? And then you have to look and say, oh, okay, I do want the boat, but is it worth having the boat in 5 years to retire 2 years later, or now have to sacrifice these other things I could do to get, and you have to look at it and say, oh, maybe I don't want the boat, or you know what? I want the boat, but okay, I won't do that 50-foot luxury. I don't know boats at all. As you can tell, I don't know boats at all. Maybe I just have to get that smaller trolley, like the trolling fishing boat versus the bigger double decker with the cabin. I can sleep underneath. It's like, you know what? I don't do the $50,000 boat. I'll do the $23,000 boat and cut it back. So, but that's the prioritizing with you. I can't say it's wrong because who wants to come sit with a financial planner and like you come down and say, Aaron, I want to prioritize a boat. I'm like, Wendy, you're wrong. That's the worst decision ever financially.
It seems to be very common to tell people that they're not allowed to buy coffee out anymore. That seems to be very common now. You're not going to be able to have a house when you're retired because you buy a coffee every day.
Not true. You're not going to be able to do what you want to do because you spend your money in the wrong place. That's what it is. It's not the fact that you buy coffee raw. If you love coffee and you want to prioritize coffee, have the coffee. It's you spend money in the wrong place. That's what it is. And it goes back to the prioritization and understanding what are the impacts. So it's the same thing with the budgeting. We talked about it. It's if I spend my money on these clothes or this concert out or these dinners out or all these things, what is the long-term impact to everything else? Because they all have a domino effect. What's the impact to getting a boat, to paying off my kids' education, to paying off the debt, the mortgage, the car payment, and retiring? What are the long-term impacts of these things? But buying $5 of coffee is not going to make you broke and not buy a house. The economy's done that to us.
Well, and the price, it used to be $1. It was $1 for a cup of coffee. I don't know what happened. But that's not what we're here to talk about. Before we do any of these things, though, we really need to make sure we have an emergency fund ready to go.
Yeah, and it's a hard balance because I know it's difficult with people, especially if you don't have an emergency fund, to say, don't invest and make sure you have the emergency fund. And the emergency fund is there because it helps with that risk capacity of how much risk you can take when you're investing. Because if you don't have that emergency fund, you're going to have to dip into those investments. And I think people have to understand that impact. That not having the emergency fund means I could have to dip into those investments, which are going to impact my long-term effects and the plans and all those things. But I think the trying to say a lot of times this can be that balance with people if they need to focus 100% on the emergency fund versus splitting between the investments, almost like a 50-50 between the two. So there is a need to do the emergency fund and have the money there. But you also have to understand, okay, what is the impact to long-term investments? So there is that same thing of where's that balance between the two? I don't think you should not focus on emergency fund. I also don't think you should go 100% on emergency fund, like putting everything you have towards that emergency without understanding, okay, how does that affect the long term? Because we know the longer you're invested, it grows exponentially over the long term. So the more money you can put in, the longer it sits there, the greater it's going to grow. You can balance the two out. So I don't think for a lot of people, it's don't ignore investing and focus 100% on emergency fund. It's find that balance between the two and your comfort level based on how much money do I need in an emergency fund and what are my life priorities and how is my life going to affect us? Because some people, if their career has a potential of changing, like if they're on contract work or they're contractors and or seasonal workers and their work is very much dependent on other people, they probably need to focus on the emergency fund a little bit more than investing. But I think other people who maybe have a stable job and don't have to worry about it, or if something was to happen, could find a job very relatively quickly in the economy, they could probably put a little bit more focus on investing and grow that emergency fund slower in comparison between the two. So it's the same thing of finding that balance between the two.
So, what is the goal of an emergency fund? How much should we have in it?
Oh God. It varies.
I hear anything from 3 to 12 months. So I'm just wondering what your
3 to 12 months.
Yeah.
My thing is it's going to depend on the personality of the person. Like everything I go back to is who's the person. So when you're talking what is their lifestyle in comparison between the two, because emergency funds are going to vary across the board. Someone who is single, has a well-paying job in like technology or IT technology or coding, and could probably find a job relatively easily and maybe staying at their parents' place, their emergency fund is going to be drastically different than someone else who owns their own business as a contractor, has 3 kids, has a house, married, has like car payments. Like it's going to be 2 drastically different emergency funds. But if I had to scale it down, okay, what should you target for? I think it's usually 3 to 6 months is usually what I would say worth of what are your expenses over those 3 to 6 months. And those things should include not just, expenses. I look and go, okay, you're like, obviously your utility bills, your lifestyle, but then even your investing along the way, it should be included in those expenses. That's the money that you spend everywhere. How much do you need? And that's what I say people should go for. But it's going to vary across the board between the two because someone who is maybe contractor, maybe may go out without business for a few months, probably needs a little bit extra in it compared to someone who's in IT. It's like, oh, they lost a job and within 2 weeks they found another one.
All right. So it's about balance.
Always about
balance.
Prioritizing life. It's always about life, prioritizing and balancing between what do you want to do to enjoy life. This stuff shouldn't hurt, and finance should let you achieve your goals, but still have fun at the same time. It's just, do I have to keep saying it? It's like a mantra I have to say every single time with this thing. It's like, it's having fun and enjoying life and reaching your goals. And this stuff shouldn't hurt, shouldn't cause anxiety and regret and frustrations. You should feel comfortable investing. Know you're happy and you're protected with funds and insurance and investing the right way that you can sleep at night to reach your goals and understand why you're investing the way you're investing and why you're prioritizing and the overall impacts between the two.
Okay. So if people have more questions, they want to talk to you about how they find that balance. How do they go about getting in touch with you?
Yes, they should talk to me because I'll help figure this stuff out.
Yes.
They can find me on my website is always the easiest way where they can book a 30-minute meeting with me right off the bat to get to know them and just have a conversation at prickfree.com or always up for emails at aaron@prickfree.com as well.
All right. Well, thank you so much, Aaron. It's a pleasure as always.
Always fun with you, Wendy.
And thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time.
Thank you for listening to the No Pricks Allowed podcast. Click the follow button to be notified when new episodes become available. Visit our website at www.prickfree.com or give us a call at 613-876-9899. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Cactus. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. The contents of this podcast do not constitute an offer or solicitation for residence in any other jurisdiction where either Aaron Buchner and/or Sterling Mutuals is not registered or permitted to conduct business. The opinions expressed are those of the authors and do not necessarily reflect the views or opinions of Sterling Mutuals, Inc. Mutual funds provided through Sterling Mutuals, Inc. Commissions, trailing commissions, management fees, and expenses all may be associated with mutual fund investments. Please read the prospectus carefully before investing. Mutual funds are not guaranteed, their values fluctuate frequently, and past performance may not be repeated.